Welcome back to the Pumped On Property Show, where in this week's episode we break down value-based investing. We studied the history of the Australian property market. We talk about some of those fundamentals and share some stories as to how we're currently feeling and how some of the people that we're talking to on a weekly basis are feeling about the Australian economy at the moment. This is the type of episode where you want to grab your pen and paper, take some notes to help you understand where the best opportunities in Australia lie right now, based on history, based on these fundamentals, and based on a value-driven strategy as an investor. Let's get stuck into it. I feel as though one of the prevailing emotions that I'm feeling a lot at the moment is this FOMO, this fear of missing out, a little bit of greed as well. Like, I want to push that envelope a bit further than I probably should and just try and maximize the returns on investment. And you and I are super fortunate that we get to talk to 15, 16 investors every single week about where they're at and where they're looking to be and what they want to be doing. And what I'm noticing is there's just a lot of uncertainty. There's a lot of emotion driving these decisions, and it just gives us this idea of we need to come back to those fundamentals. We need to come back to this approach of value investing, as opposed to just going and grabbing something because your friend has, your colleague has, your mentor has, or you're watching these things on social media or on YouTube or whatever it may be, and you're just trying to make up for lost time or try and catch up because you maybe have missed an opportunity. But I really feel as though that's where investors get it wrong, and that's where people put themselves in a really precarious situation. The whole purpose of Pumped On Property and the Pumped On Property show is to sort of share these ideas, share these philosophies, remind everybody of what truly matters, and then block out all the noise and just focus on those things.
Yeah, I think about the conversations that we've had the last week, and it's so cool to be able to lift the curtain and I guess let people into some of those conversations, and hopefully we can really sort of dive into it today. But just to kick things off, when you think about values-based investing, how would you just define it? What does it actually mean?
It's pretty simple, right? It's just trying to buy something for less than what it's worth. I think it's all about focusing on the fundamentals, having a deep understanding of history, making data-driven decisions, making those investment decisions with logic rather than emotion, and just having a long-term compounding approach as well. Not trying to get rich quick, not trying to reinvent the wheel, but just focusing on what's been tried and tested for decades, if not centuries, and consistently work time and time again. So when I look at the market, there's so little that actually meets that criteria at the moment, which simplifies things for me as an investor, because it's I don't have to look at this broad range of opportunities. I can just really hone in and focus on what I believe to be a value-based approach or a good value opportunity. But it's just as simple as that, hey?
Yeah. And I guess for you at the moment, we've been chatting about a lot, and for me, even looking at the Australian market right now, it's not hard for me to sort of point to where that value sort of is. But I guess, we've seen areas like Brisbane and Perth go on crazy runs, right? And you talk about that FOMO. When we chat to people every day, you see all this growth and it's yes, I want to jump on that. But if we look at that values-based investing approach, we're trying to look, well, what's that next area that's going to go on a run? How do we get something that's not on a run right now that is undervalued? If I look at the data between, say, Sydney and Melbourne, that median house price historically should sit at 29%. Where at the moment, there's a 60% cheaper home in Melbourne that would be the equivalent home in Sydney.
It's wild. I was just doing some research in preparation for this, and I was looking at Michael Yardney's most recent market update, and median house price in Sydney as of November or October 2025 is $1.256 million.
Wow.
That's a lot of money for an average property. And obviously there's much higher ends of the spectrum and a few lower than that as well. But then following that, it's Brisbane at 992,000. Followed by that is Canberra at 877,000. Then we've got Adelaide at 884,000. Then we've got Perth at 800. Perth is 884. Adelaide is 867,000. And then you've got, Hobart even at 686,000 and Darwin at $564,000 right now. Like, it's just insane to think that that's how expensive property prices are nowadays. And it's like, if you're coming in with a budget of, say, $400,000 or $500,000, there just isn't really anything that's worth buying anymore. Definitely nothing that aligns with those fundamentals, that aligns with that historic approach as to what we consider to be value as well. So it's just crazy to think that that's where the market is in 2025 as well.
I guess for you, like, how do you cut through the noise? Because there is a lot of noise out there. Like, we speak to clients every day. Articles in the media will push or pull people away from certain directions. And I think, for what you're talking about with that philosophy, being able to take the emotions aside and really focus on the data. Like, for you at the moment, how do you cut through all that noise and find value in the Aussie market?
For sure. And I think it's the old saying from Charlie Munger, the late great Charlie Munger. And he says that, he has this saying, which is, show me the incentive and I'll tell you the outcome.
Yeah, it's beautiful.
And, take everything that we hear with a grain of salt. Is the same way. It's the same phrase for the same meaning at the end of the day. It's like, we live in a capitalist society, a capitalist system. And so everybody's trying to get theirs, and everybody is entitled to try and go and get theirs as well. But at the same time, you just have to be a bit more curious, and you just have to have an understanding as to why a narrative is being pushed in a particular direction. And sometimes it's like incentive-based, financial rewards. Even us, like, we're buyer's agents based on the east coast of Australia that are licensed to buy in Queensland, New South Wales and Victoria. So we predominantly just talk about these three states, these three markets. And like, our incentive is to, shine a bit of a light on these markets. Now, the reason we do that is because historically they're the top three states. They've got the biggest three capital cities, the largest regional markets. Like, there's a real method to the madness there. But then there's other people that may only buy in South Australia, or they may only buy in Western Australia. And so if you just by chance happen to stumble across their content, or you get a referral to them, then you're being, I guess, pigeonholed into their philosophy, their scope of activity, and that's going to obviously limit your search criteria and limit the a more broad-based approach. And I think people need to be more borderless as well, because looking at some of the data coming out from Michael Matusik, it's indicating that Western Australia and South Australia in 5 years from now, based on dwelling approval rates and population growth rates, are going to end up being the two most oversupplied markets in 5 years from now.
Wow.
And so they've been on an incredible run. And is the next 5 years going to look as good as the last 5 years? Well, there hasn't been a time in history where that's ever been the case. So why would it be different this time around? So it means that you've got to sort of broaden your horizons and look into other locations. And then you could also look at Brisbane as a way, and like, look, that's also cranked in the last 5-10 years in some instances, in some suburbs. But you got this, like, I guess, dangling carrot in front of you with the Olympic Games in 2032. But it's like, how much real economic benefit is that actually going to add to the state of Queensland or southeast Queensland, Brisbane, Gold Coast, Sunshine Coast, given the fact that it is really only a 2-week event, and then you've got the Paralympics on top of that. So it's all just driven by speculation at the end of the day. There is some underlying fundamentals that we will get in today, so you can have that more value-based approach. But yeah, it's just like understanding that, people are going to push a particular strategy or push you into a particular opportunity based on what they have to offer. And I think that's why you got to be curious. You just got to question yourself and the person that you're talking with, like, why? Yeah. Why are you doing this? And then if it's all of this, like, fluff, this fugazi, way of talking around things, then you sort of know. But if there is, a real good backing of history, of data, of good opportunities, not just in the short term, but in the long term as well.
Talk to me a little bit more, like, you've been on a bit of a ride for the last week or so. We've sort of been chatting about it, and I guess the emotions are real though, right? Like we've got the data, we're exposed to so many clever individuals. Like I think we have some of the best access to like people who have been through different investments, different strategies. And even we still get caught up in that emotion. So I feel sorry for, the average punter out there that doesn't have like all of these resources at their disposal. But I guess for yourself, like talk us through like the last week and what that's looked like for you, because I think it'd be really cool to share.
Yeah, it's been a roller coaster ride. So I have sort of been on the sidelines for a while, but I haven't at the same time. It's like depending on who you ask, but according to myself, I feel as though I've been on the
and you're
sidelines
hard on yourself
for
as
quite
well.
some time. And so I've got enough money in my super to be able to buy a property at the moment. And so I've been working with a financial advisor, an accountant, a mortgage broker, and obviously the team at Pump to sort of figure out what I should be doing, where I should be investing. And what I found as though I was like initially thinking I'm just going to go all in on gold. And then I'm doing some research on the history of gold, and it's at all-time highs right now, and there is some history to suggest that like it should have a good run over the next few years, but it is a short history. It's not really a long history of proving that. So it kind of made me hesitate. And then I looked into property, but then I was running the numbers and I'm like, I'm trying to fit a round peg into a square hole right now. Like I'm really pushing the limits of what the banks will actually loan me in my self-managed super fund with the amount of money that we've got at the moment. So what I found myself doing is I was getting caught up in the emotion. I'm following Melbourne so closely right now and I'm getting so excited, and I truly believe that it's at the bottom of its real estate cycle with an incredible 10-year run in front of us right now. But I just got to take my own advice and realize that like if you're I guess taking on extra leverage and implementing a higher risk strategy just to try and get into the market, like is it the best option? There's the old saying, like just because you can, it doesn't necessarily mean that you should. So it's just been like a seesaw of like, yes, let's do something. No, let's not do something. Yes, let's go high risk. No, let's go low risk. And I'm still on the seesaw and I really don't know what I'm going to end up doing. But like, cause the market's so hot right now, like 3, 4, 5 months ago when I set this intention, the property that I wanted to buy was selling for $600,000 to $650,000. And I'm like, the numbers were stacking up there. And it was like, I had a good enough deposit. The cash flow was making a bit more money. But now that same property is worth like 700 to 750. It's not showing in the data yet, but it's like 100 grand more. And it's like, now my deposit doesn't go as far. I'm paying more stamp duty. The cash flow looks a little bit lower. And like, I'm still another 2-3 months away from being fully ready to buy. Yeah. So it's like, by that point in time, it's going to look like 750 to 800. And then I'm contributing more of my own cash into it, which is reducing my buffer. And I've got 3 other properties in Queensland. And it's like, my wife isn't working at the moment because we're having kids and we're trying for a second at the moment. And it's just like,
There's a lot going on.
Oh, so like you can see why I'm feeling that way and I'm on that seesaw, and thank God I've got you and Ben and Hayden and Ads and Jody all around me to support me while I'm on this seesaw and bring me back to ground and challenge me and go like, why are you doing this? And like, I think at the end of the day, I'm just going to kind of hit pause for a little bit and just reevaluate. And if a great opportunity presents itself, I'll have the self-managed super fund set up. I'll have the ability to go capitalize on something. But if I feel as though I'm continuing to end up in this scenario where it's like the numbers just don't stack up, then it's okay. Yeah. I can let it go. So that's sort of where I've been over the last, week, yes, but it's really been like a 4 to 6 month journey. Throughout this year, just being like, I want to capitalize on this last stage of the real estate cycle. And I don't know if I'm going to be in a position to be able to buy when the market does correct as well, because at that point in time, lending gets really tough. And we're going to be doing a video or podcast on that soon enough as well, where we educate everybody on what occurs when there is a debt crisis. So yeah, it's wild. So it's like, I work in this space. I'm doing this every day. I've got a world-class team of advisors. I've got incredible mentors and support networks around me, and I'm still experiencing this. I can't even imagine what it's like for the average investor that's, working a full-time job that's not in the investment space, that's, trying to consume content on their way to or from work or at night after they put the kids down. It's just, you can't even really scratch the surface, because I'm doing this full-time, and then my mornings and afternoons have been consumed by this, and it's felt like a full-time job trying to figure it all out.
And you're a bit further ahead, because I'm looking at doing an SMSF as well. I'm like, there's just so much with our family that we just have on our plate. I spoke to Ben about it, and he's just like, just next year. Don't worry about it. Just do you for like this year, and then next year, like that's where I want to open it up. And it's been interesting watching you go through it, because it really gets me thinking as well, because I've got ideas of what I don't want to do, and I've sat down with Ben and we've had good chats about it. But yeah, it's crazy, the roller coaster that everyone goes on. And it's like, it doesn't matter how long you've been doing it for or how much experience you have, like we all experience those emotions. And I guess we have fear, and it's just a matter of dealing with that fear to a level where it doesn't incapacitate us from making a decision. But like you said, being able to know when there's too much, if it's just FOMO that's driving you, then show that restraint.
That's so right. But that restraint's tough, right? It is hard to do it when you're watching people make $100,000 return on their investment in like a 3-month period.
Yeah.
Like, I want that too. That's the greed. That's the
yeah, I
greedy
know.
part of it.
And we know, like, I'm super confident with Melbourne as well, just watching it. And I've been thinking, what happens over the Christmas holidays when the data does start to come out?
I know.
And everyone's sitting down, they're not doing anything, and they go into next year with all their New Year's resolutions and driving. Like, I definitely think next year is going to be a pretty exciting year for Melbourne. And I've been thinking, I'm like, I don't want to let it, like, I feel like Q1, I don't want to let it go past then. Because I'm nervous about, like you said, if it's jumped that amount, what if it jumps another 100? Then I could be, instead of being in a really nice 4.2, am I going to be restricted to like a 3.2 or something like that?
It's just tough, because it's like these capital cities, Melbourne, Sydney, Brisbane and Perth, they only have a true bottom like once every sort of 15, maybe even 20 years. And it's like, you can see it right now, and it's tough to miss out on, what has been Australia's top performing market in the long term past. But then at the end of the day, I always understand that, like, it ripples, and it's like, just because it's Melbourne right now, and particular pockets of Melbourne, there'll be other pockets of Melbourne that represent value at some point. And then you've also got the Mornington Peninsula, you've got Geelong, you've got Bendigo, Ballarat, you've got these regional hubs on the outskirts. And then I know that once that starts to gain some traction, it generally then flows into New South Wales, and Sydney pops off, and then Illawarra, Shoalhaven, Central Coast, Newcastle regions, they start to pop off. So it's like, it's interesting to think that there's always another opportunity around the corner. Like, there's always another investment option, but you just get caught up
thinking this is the last thing. If I miss this, it's done. And
that's
it's like,
it.
Yeah.
And I don't know where that comes from. I think it's just human emotion. Like, you were talking about that that Psychology of Money book recently.
Yeah.
You've been reading it, or you've read
Yeah, the Lords of
past?
Easy Money. Yeah, and it's crazy. Just the way the world treats money. Like, we think of it as like this all-consuming sort of thing, but I guess when you go to those higher levels, like at the Fed level and stuff like that, it's just the way it can change. We've been speaking a lot about inflation in the office as well, and how money can be devalued. And part of the reason why we want to pour more money into assets is we don't want our wealth to go backwards.
No.
And I've been nervous as well personally, because I'm like, I'm not sitting on a huge amount of cash, but it's enough where I'm like, I don't want that to go backwards. Like, I had a client the other day who's, done a few properties with us, and he sort of put something so simply I've never had explained before. He goes, if I have $1 million of debt today, I know it's only worth $990,000 next month. So he's like, I'm not afraid of debt, because that money's going backwards anyway. I'd rather pour it into an asset that's going to appreciate. And it was so simple. Like, I understand inflation, but just the way he phrased that, I was like, oh, okay, yeah. It's like, if that doesn't want to make you take action, I don't know what will.
It's so true though as well, because it's like the idea of freezing that money in time, because when you buy an asset today with hypothetically $1 million worth of debt on it, that's $1 million worth of debt in 2025. And then maybe with that, you're buying a $1.2, $1.3 million asset. And we know, based on history, you should be able to average, a 5 to sort of 6% compound growth rate moving forward on that asset if you hold it for the long term. And so you've got a, $1.2, $1.3 million asset that's appreciating in value at a faster rate than inflation. And then you've got a debt position that's locked in at 2025 prices. And so, over time, you're naturally going to reduce that debt. Your cash is going to become worth less, but your debt is frozen in time. I think that's a really interesting idea to give people that confidence. And it just, once again, shines the light on the long-term approach. It's like, I don't think there's anywhere in the country where you can make short-term money at the moment. And so if that's what you're chasing, then you missed out. You missed the boat. You've got to wait until, something happens. And, at a time in the future, there will be opportunity again to make that short-term cash in certain markets, but I just don't think it's there anymore. So you just got to come back to those fundamentals.
I've heard you say it so many times when you're in calls with clients as well. It's like, you don't want to get rich fast, you want to get rich slow.
That's it.
And I really love that, because it hones in on those fundamentals at such a deep level. It's like, this is a long-term game. Like, to time property in short-term periods is tricky.
Yeah.
And you open yourself up to a lot more risk if you're doing that.
Yeah. And the short-term history, like 2020 to 2025, has given people this false sense of belief that that this is the new norm, that this is, what it's always like, because, Brisbane, Perth, Adelaide, most of Sydney, so many different places have just absolutely cranked. Like, everybody has made good money. And like, the worst thing that you could have done is buy a property in Victoria in 2020 or 2021 or 2022, because basically every single person that has done that has lost money now. But then, that gives people this false sense of belief that, like, this is the new norm. But it's like, you look back at the history of Australia, and it's like, 5-6% return is sort of normal. Anything above that, you'll take it. Anything below that, you've sort of made a bit of a mistake as well. So you just got to really have a deep understanding of that history.
Is there anything else, I guess, for you, like, where you see value around Australia at the moment? Obviously, like Melbourne, there's a lot of value there. I guess, is there anything else that really stands out of why Melbourne?
Absolutely. So, like, I did some research in preparation for this about what the data says. So if we look at the median house prices for Melbourne, Sydney, Brisbane and Perth in 1970 versus 2016, a 46-year sample size. This is crazy. The median house price in Melbourne in 1970 was $12,800.
Oh, wow.
Go grandma, grandpa. Sydney was $18,700. Brisbane was smack on $11,000. Perth, $17,500. Now, if you look at the annual compound growth rate over that period of time, it was 9.32% in Melbourne, 9.31% in Sydney. So, absolutely no difference between those two markets except 0.01% over 46 years. Brizzy was a close third at 8.75 as well, and Perth at 7.85%. So it's like, clearly Melbourne, Sydney, Brisbane, Perth are the markets that you want to be investing in. It's just determining which one of those markets is at the best stage of its real estate cycle. You don't want to be buying at the top. Like, if we look at, I know not many people are watching this right now, but they're listening to it. But if you think about, like, the Australian property market as a clock, and if we assume 12 o'clock is the peak of the market, 3 o'clock is a declining market or a downturn, 6 o'clock is the bottom, 9 o'clock is a rising market. It's not going to run like evenly around that like a clock actually does, because based on the research that we've done with Phil Anderson, the decline phase only lasts somewhere between sort of like 2 years to like 8 years. Sometimes in Perth it can stagnate for a little bit longer. And that downturn from 12 o'clock to 6 o'clock doesn't always mean that property prices are dropping. Maybe they just sit flat.
Yeah.
And, you look at Melbourne, it's like property prices are still up over the last 5 years, but they're up less than inflation over that same period of time. And then if compared to those other markets, it's really, really underperformed. And then you've got 6 o'clock to 12 o'clock, that rising stage, it could be like a 7 or 8 year cycle. It could last up to like 12 to 14 years. So, there's so many differentiating factors. Like this time around, Brisbane's cycle is likely to be extended because it really began in about 2018. and it will likely run through until 2032. And it's not going to be a nice even growth cycle over that 14-year period, but there'll be great years, there'll be average years, and there'll be decline years, but the, bottom to top from 2018 to 2032 is like that 14-year growth cycle, which is an extended cycle. Whereas like Sydney's current cycle began in sort of 2011 and it sort of ran all the way up to about 2022, 2023. And, that's a nice, 11, 12-year growth cycle. Melbourne's was like 2007 all the way up to about, 2018, maybe 2019, depending on which suburb you're looking at. So a nice, 10, 11 growth year cycle as well. And then Melbourne sort of stagnated since then as well. So 2018-19 appeared to have been the peak of the Melbourne real estate cycle. And it's hard to look, like 1,025 suburbs in Melbourne, you can't consider it one market. And we are generalising today, but it's just to give people a little bit of an understanding. Now, Perth, probably began around 2020, and who knows when that market's going to peak. It's still on an absolute tear right now, as is Brisbane. But, Sydney's, when I was just looking at some 12-month average growth rates, a lot of suburbs are starting to decline, especially those primo, expensive suburbs, close to the city or in the east. Now, there is some suburbs in far northwest, far southwest Sydney that are still moving forward because, like, the ripple effect is still getting there, and you still got 120, 130,000 people moving to New South Wales, most of them going to Sydney every single year. They've got to live somewhere. Most of them can only afford to live in the southwest and northwestern corridor of Sydney. So, like, if every single investor had their time over again, you choose to buy at the bottom.
Yeah,
like
for sure.
Every single investor, if we could go back in time, we all would have bought Bitcoin in 2011. But you can't change the past, and buying Bitcoin in 2025 at $100,000 instead of cents, it's a completely different market, and you can't expect those same returns to continue moving forward. And that's the same for Brisbane and Sydney and Perth right now. You can't buy in 2025 expecting the next 5 or 10 years to look as good as the last 5 or 10 years. But then that's the same for Melbourne. You can't buy Melbourne today thinking the next 5 years are going to look like the past 5 years. Because once again, you look at the history, that's just not how it works. And I think something that gets everybody caught out is thinking that this time it will be different. I've talked to a lot of people who believe that this time it will be different in Perth. And my question is just like, why? Like, educate me. I'm obviously getting it wrong if that's what you believe right now. Why do you believe that this time it's going to be different? Oh, but population growth rates are incredible. Oh, it's such a diverse market today compared to when the previous mining boom was occurring. And I'm like, okay, cool. Like, valid points, but still, you're buying an asset that's 80 to 90% more expensive today than it was 5 years ago.
It's funny. I've had friends say the same thing to me, like where they don't feel like we're going to go through the same cycles we had before because we're smarter now. We have more knowledge, we have AI and all these things. And I'm like, at each downturn of each cycle, there's been some kind of new thing that's got us there, right? And I'm like, AI is peaking right now. All the stocks and stuff are through the roof. And it is funny where people are like, oh, it's not going to happen again. And this book that I was reading on, the Fed and the formation of that is that it talks about we have short memories when it comes to economic hard times because we go through all of these great times and we think it's going to be like that forever. And then we get reminded again. And then we think it's going to be really bad forever. And then the people who get on early are like, oh, no, things will improve. It's just we have such short memories. And sometimes, the learning curves, we need to learn lessons over and over again by the looks of it.
Yeah, it's so interesting. And it's like the people that got decimated by the 2008 global financial crisis, it was people in their 40s and 50s and 60s. People that were in their 40s probably didn't even really it wouldn't have impacted them that much because it's like, well, they've got another full growth cycle in front of them. But if you're in your preservation age or getting close to that preservation age, it really matters and it hurts. But it's like 2008 was, almost 20 years ago now. It was freaking 17 years ago. And so that's just such a long time ago. Those people that were in their 50s and 60s are now in their, 70s. And so, and 80s, they're retired, they're past that point. And it's like the people that were in power, pushing policy back then, they've sort of moved on now as well. And you've got these young bucks in there that think they know everything and they've studied the history, but they've never really experienced it. As that's the same for us as well. It's like we're studying the history, but we have no living experience of what it actually feels like to go through
I bought
that.
my first house at the end of 2009. So
Oh,
I
there
definitely
you
experienced
go.
the brunt of the
Yeah.
GFC,
It
like,
didn't hit here until then, hey?
yeah, and it was like, it wasn't, because I was speaking about this the other day, because I was in a corporate job, like I was a stable job. I didn't really
How
have
old
any.
were you then?
I was 20, 42 now. I think I was 26
Yeah,
when I
wow.
bought that. And
Yeah.
what was crazy was that 26 or 27, I don't know, I can't do the math. I've just too much pressure right now.
Late 20s.
I think it was,
Mid
20.
to late 20s.
Yeah, mid to late 20s, around 26, 27. But I remember at the time, like, I didn't even realize what was going on because, it's crazy, right? But you're in your own world. You're insulated, so still making good money. Interest rates were high, though, at that time. They were 8.75%, I think, when I first bought. Yeah, which for now, people freak out when they hit like 6%. But I had gauged to go up like another 2% from there.
Okay.
And, then you had like my parents' generation talking about 18% interest rates. So, but I'm like, prices were lower. But I guess at that time, like I didn't even feel like it was that bad. But then after I purchased my property, checking the values naturally, you're like, oh, I wonder what it's worth. It wasn't worth what I paid for it, probably for the first 4 or 5 years after I bought it.
Yeah.
Which is bananas. And we were chatting about it this morning. I didn't really care because I'm like, I'm going to stay in this house for a while
your
anyway.
home.
Yeah, I'm living in it. I don't want to rent anymore.
You had a good job.
Yeah, I'm like, it's all good. But if you're
And
in
it
that
was entry level as well at that time.
it was $425,000.
That's it.
Like,
yeah. And so it's like, but if you were, in 2009, if you had have gone to the opposite side of the highway and born in where you currently live now, it's like that property at the time probably was like $1.2 million in sort of 2009. And it's like, then it sort of pulled back to about like 700 grand and then, pushed back forward again. So it's like, how have you made that mistake of buying at the wrong time? It's brutal. And you just got to be cautious because, as I said at the start, like nobody works this hard to lose the money that they've worked so hard for. But also what we've said there as well is you can't just leave it in cash and stack that under the mattress because inflation's just going to chew it up over time.
And part of the reason why we sort of made the move across the road from where we were at our place is I had a look at the growth figures of the current place that we were staying at the time. They were like 5%. Then across the road it was 10%. So I'm like, okay, I can double my growth by doing absolutely nothing but living in a different spot. I'm like, I can't earn that amount of money on top of like my wage and stuff like that. So it was a pretty easy decision logically. And then, it's still a bit of a freak out because you have to go jump up in the principal price. But the growth was so crazy, like over that period of time.
Imagine though, like I always think about the opportunity cost as well. And it's like, had have you known what you know today? It's like, well, back in 2009, you could have invested that $420,000 into Melbourne, as opposed to the Sunshine Coast and maybe rented on the Sunshine Coast. And like that's going against what all of our parents and grandparents have always told us, the whole rent vesting idea. But, from 2009 to like 2015, 16, you probably would have almost doubled your money in Melbourne. And that would have made you so much more money and put you in such a better position to leverage up. Obviously, it all works out, but it's like there's always that opportunity cost, and we just got to cop that. Like that's what I've come to terms with. It's like I'm just going to cop the opportunity cost loss. Like if worst case scenario, it's a lesson learned. And we're all still young and got plenty of time, so it's not a huge impact for people that are in their 20s or 30s or even 40s. But it's like really important for those that are in their 50s and 60s to avoid making bad mistakes at the moment. So you always got to look at that opportunity cost loss by, choosing one thing over another. And that's where, I think a deep understanding of history is really important. Now, I might just dive a little bit deeper into the history, if that's right. So CoreLogic did this study from 1992 to 2022, 30-year period. It was the long game, 30 years of housing values. They look at like the capital cities versus the regions, and the top performing capital city from 1970 to 2016 was Melbourne, as we just looked at before, followed very closely by Sydney. From 1992 to 2022, same outcome. Melbourne, top performing market, up 459%, followed by Sydney at 449%. So 10% different over a 30-year period. but we still know that Melbourne and Sydney have the highest percentage return on investment over the longer period of time. So that looks like a 5.9% annual passive income in Melbourne and a 5.84% annual capital growth rate in compound growth rate in Sydney. Now the remaining capitals combined was 409%, which was really solid return, which once again tells you go to the metro markets, and even if it's not Sydney or Melbourne, it's Brisbane or Perth or Adelaide. And then, some parts of Canberra and Hobart and Darwin do good at different times as well. And then the national for all Australia was 382%. So looking at like the combined capitals and the combined regionals. Now, in this study, it was indicating that the combined regionals, and that's taking into consideration Gold Coast, but also Broken Hill in New South Wales, or Karratha in WA. Like it looks at the big and the tiny, but they were up over that period of time about 312%. So once again, like it just continues to push you into those major metro markets. So, there's obviously a lot of people that are reaching out at the moment and they're trying to figure out, and the most common question that I'm getting is like, where? Like, I'm not too sure where to buy. I'm not too sure what to buy. Well, history suggests that we should be going for the major metro markets. That's what those fundamentals look like. That's what the history is indicating. That's what the data is indicating. But I want to jump into a little bit of a comparison between Sydney versus Melbourne. And I picked out a couple of suburbs in Sydney and a couple of suburbs in Melbourne as well. Now, as you were saying before, like the long-term average has been about a 29-30% difference in the median house price between Melbourne versus Sydney. And currently in some areas, it's sitting at over 60% different. So what I've done is I've pulled out a suburb in South Sydney, Sylvania Waters, that's 19 kilometres from the city. It's on the water, but it's not like a beach. They're like canal front homes. It's on the Georges River. And then I've also picked off Cheltenham in southeast Melbourne, which is 18 kilometres from the Melbourne CBD. And super close to the water as well, but it's more like a beach, like it's close to the Brighton beach.
Nice.
And so it's probably a little bit nicer than the Georges River on those southeast beaches. So, 1 kilometre closer to the city and access to a nicer beach as opposed to what you can get in Sylvania Waters. Now, the median house price in Sylvania Waters as of 2025 is $3.15 million. The suburb is up over the last 10 years, 12.62% average. So that's 126% up today compared to 2015.
Jeez.
Cheltenham, the median house price is still bloody expensive. It's $1.185 million, but less than half that of Sylvania Waters. And the market's only up 5.75% per year for the last 10 years, making it 57.5% more expensive today than it was 10 years ago. If we're implementing this value investing approach, where do we invest? In Sylvania Waters or do we invest in Cheltenham? If you've got ridiculous money to spend. It's just so simple, and it's like, I get a lot of people that are like, yeah, but Sydney's so much better than Melbourne. You've got to pay a higher stamp duty in Melbourne. You've got to pay land taxes in Melbourne. What about the budget deficit? What about all the social political issues down there right now? This is a short-term reality. And once again, I don't want people to look at, a 5-year time horizon and think that this is the new norm. I'd much prefer people to look at the last 30 years, look at the last 50 years and make their decisions based off that as opposed to the short-term future. Because when you look at what's happened since 1970, so Australia's experienced 4 recessions since 1970. This is in 1974 and 75. This period saw negative GDP growth in the third and fourth quarters of 74 and the first quarter of 75. In 1981-83, a double-dip recession that started with a contraction in late 81, followed by a brief recovery and then another series of contractions from late 82 through to the second quarter of 1983. Interestingly enough, these are all around sort of the end-of-cycle recession or the mid-cycle slowdown. Then we saw another one in 1990, 91, First quarter of 91 saw a negative GDP growth of 1.3%, and the second quarter a 0.2% fall. So very marginal at that point in time. And then 2020, the COVID-19 pandemic led to a recession in the first and second quarters of 2020. Very marginal, 0.2 and 6.7% fall in real GDP respectively. So, you know, there's been 4 recessions over the last 50-something years. There's been multiple changes in government. There's been multiple changes in fluctuating interest rates, fluctuating unemployment rate, fluctuating inflation rates, fluctuating population growth rates. There's been good times, there's been bad times, there's been everything in between, and we've still seen an incredible return on investment over that extended period of time. So, you know, just don't, as you said, we have this recency bias, and, you know, that's where so many investors get caught out at the moment. So, yeah, it's just really interesting to see. Now, obviously, that was like a really expensive price point, but if we look at some more affordable locations, so in southwest Sydney in the Campbelltown region, there's a suburb called Claymore. It's 42 kilometres from the Sydney CBD, down in the southwest. It's currently got a median house price of $946,000, and the market has increased by 10.8%. over the last 10 years. So that's 108% up over the last 10 years, according to that information. And then in Melbourne, you've got a comparable suburb in northwest Melbourne called Brookfield. It's 40 kilometres from the city. It's currently got a median house price of $550,000, and it's seen a 10-year average annual growth rate of 5.16%. So when we're implementing this value-based approach, it clearly indicates to me that there is so much more value investing in Melbourne right now than there is in Sydney. Yes, there is some headwinds and sacrifices that need to be made in paying more stamp duty, paying more holding costs in land taxes, and it may take some time for, you know, that budget deficit to be to get back to a better place. But we've seen bad times in Australia in the past. We've seen them in the recent past, and we will see them again in the future. But what it indicates to me, as we continue to see people move to the country, as we continue to see, you know, the land values capture a lot of the economic benefits, you know, these markets should continue to perform really well over the long term. So it's pretty wild when you actually analyse case by case like that, isn't it?
No, and I think like just showing that data as well, it's clearly visible where that value still lies. I think of it, there's still juice left in the tank. You know, where some areas are like they're pretty cooked on growth.
Yeah. And the interesting thing as well, it's like you look at the last 50 years, according to the data. You know, 9.32% in Melbourne, 9.31% in Sydney, 8.75% in Brisbane, 7.85% in Perth. So if you're looking at a suburb like Sylvania Waters or Claymore, that are up 12.6 and 10.8, that's considerably above the longer term averages, which gives me an indication that, like, there ain't anything left in the tank there.
No.
Based on historic averages. And do I believe the future is going to be as good as the past? I don't. And then in Cheltenham and Brookfield, 5.75 and 5.16, when the long-term averages has been 9.32, it's like
it's underperforming.
It's underperforming compared to those longer-term averages. So it just gives me more confidence. But yeah, it's just really interesting, and I think it's like really important to hone in and focus on those fundamentals. Have that value-based approach, like make your decisions based on real fundamentals, history, make data-driven decisions, and focus on long-term compounding approach as well. That's where you will succeed. Don't try and get rich quick. Don't try and make short-term money, and just really pray and hope that history repeats in some way, shape, or form.
It has a habit of doing it, though.
It does have a habit of doing it. But yeah, any other questions?
No, I think that's pretty good. I feel like that we've covered a lot today, but I feel like that's really good. Give people some good insights, and yeah, hopefully help them on their journey.
I love this shit, eh? Like, to me, it's just like, how do we find that needle in a haystack? And it's just like, I feel as though we've just really highlighted where that needle in a haystack is. And I was looking at Melbourne. There is some suburbs that are still up 9, 10, 11, 12% over the last 10 years. do your research on those longer term averages, and try and invest in those suburbs that have done a lot less than that, because not all cities are considered equal as well. Same for Sydney. Like, there's some areas of Sydney that have only done 6-7% for the last 10 years, so like they probably have more left in the tank there. Same in Brisbane and Perth. Like, there is still some suburbs that have performed below those longer term averages. So, don't go buy the overvalued region just because it's performed well recently. Go find that undervalued needle in a haystack that's going to be the next domino to fall.
Oh, awesome, man. Thanks heaps, hey. Good
Good.
chat.
Cheers.
G'day guys, my name's Ben and I'm the director here at Pumped on Property, and I just want to say a massive thank you for watching our content today. Now, if you're thinking about buying an investment property in the next 3 to 12 months, then the team and I would love to offer you a one-on-one strategy session. In that session, we can talk about exactly where you are right now, where you'd like to be longer term, and we can deeply educate you on the Australian market. And then you can take that information and go and absolutely smash it on your own, or potentially become one of the small number of clients that we work with each week. To book your session, all you have to do is go to www.pumpedonproperty.com and click that book your free strategy session button. But either way, we wish you all the best on your journey as an investor to financial freedom.